Right now, as you are watching this video, the IRS has quietly activated one of the most sweeping enforcement changes in decades. And it is aimed directly at two groups of people who can least afford to be caught off guard: seniors living on fixed incomes and immigrants who worked their entire lives to build something in this country. We are talking about a new 2026 filing rule that the government buried in regulatory language so dense and so confusing that even experienced tax professionals are scrambling to understand it. And if you or someone you love falls into either of these groups, the price of not knowing could be $100,000, not a penalty, not a fee, $100,000 gone, legally taken because of a paperwork rule you never heard of. Stay with me, because what I'm about to tell you could be the most important financial information you receive this entire year. Let me be absolutely clear about what this new rule actually is, because the mainstream media is not covering it the way they should. Beginning with the 2026 tax filing season, which means returns filed in 2026 for the 2025 tax year, the IRS has implemented what they are calling an Enhanced Foreign Asset and Income Reconciliation Protocol, bundled inside the expanded FBAR and FATCA enforcement framework. What that means in plain English is this: the IRS has dramatically expanded its ability to cross-reference foreign financial data, foreign income, foreign pension payments, and foreign asset holdings against every tax return filed in the United States. They are now receiving automated reports from over 60 foreign governments and more than 100,000 financial institutions worldwide. Every bank account, every pension, every inheritance, every property you own abroad. They can see it now, and they are comparing it against what you reported or did not report on your return. The threshold for triggering automatic penalties has been lowered. The definition of what counts as a foreign financial asset has been expanded, and the statute of limitations for auditing these returns has been extended. This is not a random audit lottery. This is a targeted, data-driven enforcement sweep, and the data is already telling the IRS exactly where to look. Here is where the $100,000 number comes from, and I need you to understand this is not an exaggeration. It is not a worst-case fantasy. It is the mathematical reality of how these penalties stack. Under the existing FBAR rules, a willful failure to report a foreign bank account carries a penalty of up to 50% of the account's value per year, capped at $100,000 per violation. Under FATCA, the failure to file Form 8938 for foreign financial assets carries penalties starting at $10,000 and escalating to $50,000 if the IRS sends you a notice and you still do not file. Now, here is the part that makes this so dangerous for ordinary people. The IRS does not need to prove you intentionally hid money. They have shifted the burden. If they can show that you had access to foreign financial information and did not report it, the penalty structure treats it as willful. And willful means the full hammer comes down. A senior who has a modest pension from Italy, Germany, Greece, or Mexico, something worth $40,000 or $50,000, can face a penalty that exceeds the entire value of the pension. An immigrant with a small savings account back home that a relative manages on their behalf can receive a notice that wipes out everything they saved in America, trying to pay a penalty on money they barely touched. This is happening right now, and the 2026 rule changes make it worse. Let me walk you through a scenario that is frighteningly common. Imagine Maria, 68 years old, born in the Philippines, a United States citizen for 30 years. She worked as a nurse. She paid her taxes every single year without fail. When her mother passed away 4 years ago, she inherited a small house and a bank account with approximately $80,000 in a Philippine bank. Her cousin manages the account. Maria receives small transfers from it occasionally to help cover living expenses since she retired. She did not know she was required to report that account on an FBAR form. Her tax preparer, a nice person at a local office who does simple returns, never asked her about foreign accounts. Under the new 2026 enforcement sweep, the IRS receives an automated report from the Philippine financial institution. They match it against Maria's returns. They see 4 years of unreported foreign financial assets. The penalty assessment starts at $10,000 per year for failure to file FATCA forms. Then the FBAR penalties layer on top. By the time a letter arrives in Maria's mailbox, she is looking at a 6-figure demand. And if she does not respond correctly and quickly with the right professional help, that demand becomes a lien against her home. Now consider James, 74 years old, a retired engineer who came from Nigeria decades ago. He and his brother still jointly own a piece of land their father left them. The land generates a small rental income, maybe $3,000 a year, that James's brother collects and uses mostly for family expenses back home. James sees almost none of it. But legally, as a 50% co-owner, he is required to report that rental income and declare that foreign asset on his U.S. tax return. He did not know. His accountant did not ask. Under the new 2026 rule expansions, that property now falls within the expanded definition of a reportable foreign financial asset. The IRS sees the land in Nigerian land registry databases that have been shared through international data exchange agreements. James is now looking at penalties, interest, and the potential for a criminal referral if the IRS decides his non-reporting was willful. A man who served this country, paid into Social Security, raised his children as Americans, facing criminal exposure over a piece of farmland in Lagos that he has never even visited. I want you to feel the weight of these stories, because they are not rare. They are playing out across this country right now in communities of Greek Americans, Mexican Americans, Chinese Americans, Indian Americans, Korean Americans, and in quiet suburbs where retired seniors have no idea that a bank account their family manages overseas is a ticking time bomb on their tax return. The IRS has the data. They have the algorithms. And starting in 2026, they have an expanded mandate and increased enforcement budget specifically directed at this category of non-compliance. The agency calls it closing the tax gap. I call it targeting the most vulnerable people who simply did not know the rules. Now, let me explain exactly how this new filing rule works at a mechanical level, because understanding the mechanics is how you protect yourself. The 2026 changes operate on two tracks simultaneously. The first track is reporting expansion. The IRS has lowered the reporting threshold for certain foreign financial assets and broadened the definition of what must be reported. Previously, some assets held through foreign partnerships or family arrangements could fall outside the strict FATCA reporting requirement. Under the new rule, those gray areas have been eliminated. If you have any beneficial interest in, meaning any right to receive money or assets from, a foreign account, property, business, or financial arrangement, it must be disclosed. The second track is enforcement intensity. The IRS has hired and is continuing to hire thousands of additional agents specifically trained in international tax compliance. They are using artificial intelligence to cross-reference data from the Common Reporting Standard, which is the global financial transparency framework that now covers over 100 countries against U.S. tax returns. The system flags discrepancies automatically. A human agent then reviews the flag and decides whether to initiate an examination. The decision-making is faster, the data is more complete, and the enforcement funnel is wider than it has ever been in American history. There is something else you must understand about the 2026 rule, and this is the part that makes tax professionals genuinely alarmed. The IRS has changed how it handles voluntary disclosure for people who come forward on their own to correct past non-filing. The streamlined filing compliance procedures, which were a relatively forgiving pathway for non-willful violators to get right with the IRS at a reduced penalty, have been tightened. The qualification criteria are stricter, the certification requirements are more demanding, and there is credible guidance emerging that the IRS intends to challenge more streamlined submissions as ineligible, essentially pushing people out of the reduced penalty pathway and into full penalty exposure. What this means practically is that the window to self-correct at a manageable cost is closing. If you have unreported foreign financial assets or income, every month you wait is a month that window gets narrower. So what do? What are the exact steps you must take right now to protect yourself? The first and most important thing you must do is audit your own financial life. Sit down and make a complete list of every financial connection you have outside the United States. Every bank account, whether you control it actively or a family member manages it on your behalf, every pension from a foreign government or employer, every piece of real estate you own or co-own abroad, every business interest, even a minority stake in a family business, every inheritance you have received or expect to receive, every trust arrangement where you might be a beneficiary. Write it all down. Do not assume something is too small to matter. Do not assume that because you are not actively using an account, it does not need to be reported. The IRS does not care whether the account is active. They care whether it exists and whether you disclosed it. The second step is to immediately seek out a tax professional who specializes in international tax compliance, not a general tax preparer, not the franchise office on the corner. A certified public accountant or tax attorney with specific experience in FBAR, FATCA, and international reporting. Ask them specifically whether you qualify for the streamlined domestic offshore procedures or the streamlined foreign offshore procedures. These are still available and can dramatically reduce your penalty exposure if you qualify and act now. The cost of hiring a specialist is a fraction of the cost of a penalty assessment. The third step is to act with urgency. If you have already received any correspondence from the IRS about foreign accounts or foreign income, do not ignore it and do not respond to it without professional guidance. The worst thing you can do is reply to an IRS notice on your own without understanding your rights and your options. Every word you write becomes part of the record. I also need to warn you about something dangerous that is spreading through immigrant communities right now as this enforcement push becomes more widely known. Scammers are already exploiting this fear. You may receive phone calls, text messages, or emails claiming to be from the IRS, warning you about your foreign accounts, and demanding immediate payment to avoid arrest or deportation. The IRS does not call you without first sending written notice. The IRS does not demand payment by gift card, wire transfer, or cryptocurrency. The IRS does not threaten deportation. If you receive any communication like this, it is a scam. Hang up. Delete it. Report it to the FTC at reportfraud.ftc.gov. Real IRS enforcement comes by certified mail. Real professionals will never ask you to pay them in gift cards to resolve a tax issue. If you are a green card holder, I need you to hear this especially carefully. Permanent residents are subject to U.S. tax law on their worldwide income in the exact same way as citizens. The fact that you are not yet a citizen does not reduce your reporting obligations by a single dollar. In fact, green card holders are sometimes at greater risk because they may not have had access to the same tax education and legal guidance that citizens receive over time. And if you are in the process of applying for citizenship, unresolved tax compliance issues, especially anything related to foreign accounts, can surface during the naturalization background check and create devastating complications for your case. Get your tax house in order now, before it becomes a barrier to the future you have worked so hard to build. For the seniors watching this, I want to speak to you directly and personally for a moment. You spent your life working. You paid into a system that promised to take care of you. You do not deserve to be blindsided by a rule written in language designed to confuse. But the reality is that the government does not grade on effort. They do not give you credit for not knowing. The penalty for non-compliance is the same whether you were ignorant of the rule or whether you deliberately tried to hide money. That is deeply unfair. And I am angry about it on your behalf. But being angry does not protect you. Knowledge protects you. Action protects you. And taking that action right now, today, while the window to correct mistakes voluntarily is still open, that is the most powerful thing you can do. Here is what I need you to do before this video ends. First, share this video immediately with every senior and every immigrant family member you know. Put it in your family group chat. Text it to your parents. Post it in your community group. The people who need this information the most are often the ones least likely to find it on their own. Second, write down in the comments below whether you have foreign accounts or foreign assets that you have never reported. I am not asking for details. I am asking you to acknowledge the situation to yourself, because that acknowledgement is the first step toward fixing it. Third, subscribe to this channel and turn on the notification bell, because this is not the last rule change that is coming for seniors and immigrants, and you cannot afford to miss the next one. Fourth, call a qualified international tax professional this week, not next month, not after the holidays, this week, and have the conversation that could save your financial life. The IRS has better data than they have ever had. They have more agents than they have had in years. They have an expanded mandate, an increased budget, and an artificial intelligence system that is working around the clock matching foreign financial data to your tax return right now. As you sit here watching this, you do not have the luxury of waiting. You do not have the luxury of assuming your situation is too small to matter or too old to be revisited. The statute of limitations does not start running until you file, which means unfiled years remain open indefinitely. This is not a threat I am making to scare you unnecessarily. This is the law, and it is being enforced with tools and resources that simply did not exist 5 years ago. Protect yourself. Protect your family. Do not let a paperwork rule, a rule you never heard of, written in language designed for lawyers, take away what you spent your life building. The time to act is right now, not tomorrow. Right now.